Have you ever wondered why your money seems to buy less than it used to? Why the cost of everyday items steadily climbs? Today, we're diving deep into one of the most critical, yet frequently misunderstood, economic phenomena: inflation. This isn't just about rising prices. It's about the fundamental value of your money. Inflation is a term constantly circulating in financial news, policy debates, and even our daily conversations. Despite its ubiquity, its true nature often remains obscured by oversimplifications and misconceptions. For students grappling with economic principles, investors planning for the future, or the general public trying to make sense of their finances, a precise understanding is paramount. To truly grasp the implications of inflation, especially concerning assets like gold and silver, we must first establish a clear, objective definition. We need to strip away the noise and focus on the core economic mechanics at play. The most common, yet incomplete, definition of inflation describes it merely as rising prices. While prices do indeed rise during inflationary periods, this description misses the fundamental cause. Prices are symptoms, not the disease itself. They don't spontaneously increase. They adjust in response to underlying economic forces. A more accurate and analytically robust understanding frames inflation as a change in the intrinsic value of money itself. It's not that goods suddenly become more valuable. It's that the currency used to purchase them diminishes in worth. This crucial distinction shifts our focus from the cost of goods to the purchasing power of our money. At its analytical core, inflation signifies a reduction in purchasing power. This means that a fixed unit of currency, say $1 or €1, will acquire fewer goods and services today than it did yesterday, or certainly fewer than it will tomorrow. If you consistently require more monetary units to acquire the same basket of goods over time, it indicates a depreciation of the currency's value. Consider this. If a loaf of bread cost $1 last year and now costs $1.10, it's not necessarily that the bread itself is inherently more valuable. Instead, the dollar has lost some of its capacity to command goods and services. This perspective highlights inflation as a monetary phenomenon, driven by dynamics within the money supply and demand, rather than solely by the supply and demand of individual commodities. Prices serve as the primary mechanism through which inflation becomes observable to the public. When the value of money erodes, market participants, from producers to retailers, adjust their pricing strategies to compensate for this loss. This adjustment ensures they can maintain their real revenues and cover their costs, which are also subject to the same monetary devaluation. However, this adjustment is rarely uniform across the economy. Some prices, particularly those for essential goods or services with inelastic demand, may rise rapidly. Others, perhaps for discretionary items or those in highly competitive markets, might increase more slowly or even remain relatively stable. This unevenness is a direct consequence of how money circulates and impacts different sectors at varying speeds and intensities, reflecting complex supply chains and market structures. Inflation is far from a modern invention. It is a recurring theme throughout economic history. Even in eras dominated by commodity-backed monetary systems, such as those based on gold or silver, inflation occurred. A classic example is the debasement of coinage, where rulers would reduce the precious metal content of coins while maintaining their face value. This effectively increased the money supply without a corresponding increase in real wealth. When the silver content in Roman denarii declined, for instance, merchants and citizens quickly recognized the reduced intrinsic value, leading to a general increase in prices for goods and services. This historical pattern underscores a critical insight. Inflation is not primarily a product of human greed or transient market sentiment. Instead, it is fundamentally driven by systemic changes in how money is created, managed, and circulated within an economy, whether through physical debasement or modern monetary policy. A common analytical pitfall is conflating inflation with the cost of living. While intimately related, these two concepts are distinct. Inflation specifically refers to the erosion of money's purchasing power. The cost of living, conversely, measures the aggregate expenses required to maintain a particular standard of life in a specific geographic area. It encompasses a broader range of factors beyond just monetary devaluation. Increases in the cost of living can stem from various sources that are not purely inflationary. These might include genuine supply shortages for critical goods, significant technological advancements that raise production costs, or new taxes and regulations imposed by governments. Understanding this distinction is crucial for objective economic analysis, allowing us to attribute price changes to their correct underlying causes rather than solely to monetary expansion. The experience of inflation is profoundly personal and often unevenly distributed across different segments of society. Individuals whose incomes are indexed to inflation or who possess assets that appreciate during inflationary periods may feel a relatively minor impact. Their purchasing power might be largely preserved. Conversely, those on fixed incomes, retirees, or individuals whose wages lag behind the rate of price increases often bear the brunt of inflation. Their real income diminishes, making it harder to afford necessities and maintain their standard of living. This disparity in experience can lead to widespread confusion and a sense of unfairness, even when the underlying causes are systemic and macroeconomic. Historical data consistently illustrates this pattern, highlighting the social and economic challenges posed by sustained inflation. Misinterpreting inflation leads to flawed economic analysis and ineffective policy responses. If we mistake symptoms for causes, we risk implementing solutions that fail to address the root problem. Focusing solely on rising prices without understanding the monetary dynamics behind them can lead to misguided interventions. A clear, objective understanding of inflation empowers us to critically evaluate monetary systems, assess the impact of central bank policies, and understand the role of alternative assets like gold and silver as potential hedges against monetary devaluation. This analytical clarity allows for informed decision-making, free from fear or speculative bias. Ultimately, inflation is not merely about the price tags you see. It is a profound economic phenomenon reflecting changes in the fundamental value of money over time. Prices are the visible signals, the market's way of communicating the shifting purchasing power of our currency, but they are not the source of the change. With this foundational understanding, we are better equipped to explore the intricate relationships between money creation, various monetary systems, and the historical and contemporary roles of precious metals in preserving wealth. In our next discussion, we will delve into the specific mechanisms that drive prices upward and examine what centuries of economic history teach us about these processes. This content is provided for educational and informational purposes only and should not be construed as financial, investment, or economic advice. Always consult with a qualified professional before making any financial decisions. If this deep dive into inflation has clarified your understanding and sparked your curiosity, please like this video and subscribe to our channel for more insightful economic analysis. Your engagement inspires us to continue creating valuable educational content. Share your thoughts and questions in the comments below. Let's build a more financially literate community together. Thank you for watching, and we hope you have a blessed day.